In fact, one of the stocks which has been in focus since yesterday has been Zaggle on the back of those numbers that it declared. Really, the concerns are just a couple of concerns. The growth has been extremely strong. They've beaten the growth guidance. But in terms of cash flow, and cash flow especially from getting blocked in receivables and working capital items of around 150 odd crore, that is where the drag seems to be. And that's where probably investors are also a little bit worried. Mind you, it did a positive cash flow from operations in FY25, FY26. We've continued to see a drag. Let me bring on board Raj P. Narayanam, founder and executive chairman at Zaggle, to discuss exactly that. Great having you, Mr. Narayanam. Let me first start off by asking you, what's your assessment of the concern? Is it just cash flow driven, or there's something else which investors are worried about?
No, Harsh, thank you so much for inviting me on the show. I think this is, Zaggle is a growing company and has been growing at a hectic pace of about, 40 to 45% over the last 3 years. And if you see, the receivables are capped at like, March 31st. So it's a one cutoff date which is taken. Okay. And because it's like the year end, what happens is a lot of redemptions happen, and we need to ensure that once we bill them there, okay, the payments are going to come over the next 45 days. So in my opinion, that's very natural because on a 1900 odd crore revenue which we have, it is within permissible limits, but we continuously are looking at how do we improve that, and that's what we are going to do in this quarters, coming 2, 3, 4 quarters, and we are bound to have positive cash flows by the year end.
When I was doing the math, Mr. Narayanam, you have, and correct my math if I'm wrong, what you're penciling in for FY27 is approximately a 40% growth on a 1900 crore top line, which takes your top line to approximately 26 to 2700 crore if you meet your guidance. Of course, you've met your guidance on most occasions on all of your occasions in the last few years. In fact, you've beaten it. But say you meet it this time around, you'll do approximately 2700 crore in terms of top line. But margins, on the margin count, can you do 9 to 10% margins? Give us a sense of that first.
So on a standalone basis, we have absolutely, no worries. The range could be just in and about that. So I don't see any major change there in the in the margins. On a consolidated basis, because these are like, a couple of companies which we have acquired are growing at a very, very rapid pace. And the margins could move a little bit here and there. But overall, for a standalone, we remain committed to our margins. And the whole idea is that to reach to a level of about 15%, EBITDA margin, which we had, committed by in the next 4 or 5 years. So that is where we are moving towards.
And okay, but that is 4 or 5 years away. Can you do a 9% margin? Because on Propel, the margins have come off for you. So can you, despite that, and you've cut your guidance there as well, maybe 6% margin is what you're guiding for, if I've understood this correctly. Can you do a console margin of 9.5 to 10% next year? Is that something we can pencil in?
I'll explain it to you. Okay, so in my SaaS business, I have got about 95 odd percent as gross margin. And we are significantly improving our SaaS margins, as well as from 95 we go to 96, 97. And overall in the pie of SaaS pie in the overall business, also we are improving. Okay, so in my opinion, we should really, really work hard towards also maintaining the Propel margins, because Propel business is a large business. And we have invested significant amount of effort in the Propel business. So there should be an uptick in that business as well.
Okay, so Propel business should also see an uptick. But why has there been a downtick, Mr. Narayanam? If you can just explain that very quickly.
Okay, so it also depends on whether the ORC commissions have come or not. In that particular quarter, sometimes merchants don't pay you that overriding commission, and it gets booked in the next quarter. So what we are today looking at is that how do we maintain the the growth rate without diluting the margins and improving cash flow. So these are the three levers One is revenue growth, the second is operating cash flow, and cash flow is our focus. And then is the margin. So margins also, we are going to work harder and harder to improve the margins. And as we go on at a consolidated level, we will be able to tell you exactly where we land.
I'll take a step back now. But your top line guidance of around 2,700 crore or 26 to 2,700 crore for FY27 at a 9% margin will likely take you to a 240 crore of EBITDA. Your receivable clip has been going up by, say, 150 to 180 crore in the last 12 months. Do you expect your receivable clip to go up by 250 crore in the next year, or will it come off?
No. I think it will come off. Significantly, it will come off.
Exactly. So by how much? Give us a perspective, because you're currently sitting on... Yeah.
So I think, in those terms, we possibly, would be same, at about 160 to 180 crores is where, we possibly will land in spite of the expansion, because the kind of measures which we have taken for overall, cash flow positiveness in the business has been significant. It's already yielding results. And as you see in the coming quarters, you will see more results of that. And we probably on the receivable side, we should be roughly about 180 odd crores.
Okay, 180 crore more. So on the 360 crore rupee receivable base that you're currently at, it'll go up by nearly 50% next year.
No, it will. No. So what I'm saying is that 360 crore receivable base will come down.
Will come down. By how much?
Will come down, and will come down, possibly, by about, let's say about, 80 to 100 crores.
By 80 to 100 crore, it'll come down, which will mean that you'll do 320 crore of cash flow net of gross of taxes.
Gross of taxes, we should be able to do that cash flow. Cash flow is going to be positive. Is what is our effort. We are going to put in as much effort as possible to make it positive. Similarly, if you look at it in terms of the receivables, we are going to try and control that receivables as much as possible. So, but also to give you a very clear indication, for us, cash flow positive is the barometer. Okay, so that is what we are going to focus largely on. Growth, of course, we have to do the growth, and that's why we have, it is easy to give you a guidance of 40%. And last 3 years, if you see, we have never ever, whatever guidance we have given, we have been able to meet that guidance. Okay, so it's easy to give, but that's why we are giving a 25 to 30%, on standalone and 40% on a consolidated basis. We could have easily, but if you really ask me and say, Raj, what's your opinion? I probably will say that we might grow at 45%, but we still have been very conservative. And the idea of being conservative is to improve cash flow, improve margins, and, the operating leverage which has kicked in, to utilize it as much as possible.
Thank you so much, Mr. Narayanam, for coming in. Unfortunately, I'm completely out of time. I'm going to have to call you again, Mr. Narayanam. Sorry, but yes. I'm really going to have to call you again. Really curious to understand what's playing out on the stock price, because you've seen a very sharp fall. I've not been able to do full justice. Thank you so much, though, for coming in and speaking to us.
Thank you. No, would love to also pick up the stock at this price. It's a fantastic price, and I want, I'm saying whatever money I have, I'm going to put in there, to buy my stock.
Right. I would love to talk a little bit more about that, but I'm going to have to park that for another time, unfortunately. My producers are pressuring me to close this. So let me close this. Thank you so much for coming in and speaking to us. Out of time on this edition. Thank you so much for joining.